And I'm going to hand over to you to take us through a bit of a presentation, set the scene, and then we'll have a bit of a conversation and questions. So over to you, Anthea.
Super, thanks very much, Carl. And again, a big thank you to you and the CN&Co team for organizing another webinar, and particularly actually to everyone who's joined us live. I mean, I'm really loving engaging with some of the top minds around the world, kind of on webinars virtually, and I like that it's the new normal, but wow, aren't we getting a lot of webinar invitations, eh? Even Sunday evenings, for heaven's sake. So let me get started. And Carl, you almost disappointed me, by the way. Yeah, I was hoping for you to call me a cyclist, and I have my Ironman medal with me. I'll show you after the presentation.
Listen, there's still some time. I've got a few tricks up my sleeve, but I thought we'll get to the presentation.
How could I underestimate you? How silly. Right, so a deep dive into offshore markets. And I'm pretty sure that at some stage, everyone has experienced this feeling. I'm stuck between the grass isn't always greener on the other side, and I keep watering the grass I already have, but it's not getting any greener. And then before I actually take this deep dive, I want to remind everyone of the opposite adage, don't put all your eggs in one basket. And the reason I've brought this up is particularly true when you look at the world from an economic perspective. And though it applies to every single investor, this pertinent infographic of the global economy shows you that if you're a South African, you make up less than 0.5% of the world economy. And so tell me again why you would put all your eggs into this one basket. The other side of the argument, of course, and you've heard me talk about it before, is matching your assets and liabilities and making sure you have enough assets to cover your liabilities. And I'm going to add with minimal currency translation risk. So consider this. Your retirement is a liability because you need to spend money to live, and because most of you won't have any income when you retire. Your pension fund is your asset, which will match or support your retirement cash flow needs. So imagine, if you will, that you had all your money invested in Mexico and the peso plummeted in value. When you then come to return to South Africa, that peso translation into rand is likely to be worth a lot less than you originally invested. In reality, we want to be invested where we see growth without putting our hard-earned money at risk. Anyone know how many countries there are in the world? For those of you who don't know, I can't hear you, it's 195. And by the way, if you're ever looking for some fantastic infographics, I just remembered, you must go to visualcapitalist.com to find the same as these. But anyway, I must tell you, I am a bit Alice in Wonderlandish inquisitive. So down the rabbit hole I went the other day, and also found out that according to Wikipedia, only 37 of those 195 countries are considered emerging markets, depending on, of course, on who is defining what an emerging market is, and then who's doing the counting, right? So I think kind of, you know, there's the World Economic Forum, there's IMF, there's a whole lot of these institutions that define, so anything between 37 and 42. And now you're going to have to take my word for it. As someone who has worked in global banks, that generally speaking, global investors look at emerging markets as one investment destination. And sure, some emerging markets have better beaches, or their stock markets are more stable or liquid than others. But in the big picture, the correlations are just too strong to ignore. And I know I sound a bit like those people that I detest, you know, the ones who think that Africa is a country. We're not, we're all different. But for the purposes of this webinar and brevity, I want to exclude emerging markets as an investment destination, because I think that if you're already living in an emerging market country, it means you already have significant exposure to emerging markets. And then also, because it is my webinar and I can make the rules, I'm actually going to include China in this presentation because, quite frankly, I just don't know how I could possibly ignore 1.4 billion consumers. So let's start with an overview. Trade globalization is a measure of economic integration. On a global measure, it basically represents the proportion of all world production that is used for imports and imports and exports between countries. And the reason for putting this graph up is to show you that there's been a fairly sharp decrease in globalization in the last decade. And we do need to bear it.
I'm just going to interrupt you there. Sorry, I've been so fascinated listening to you and making my notes about what I'm agreeing with and disagreeing that I was not missing the fact that your presentation is not up. But I know that you like a slide. So we just need to share that and test it, please. Sorry for interrupting you.
That's a bit silly of me. That's very silly of me.
There we go. Perfect. All up.
Now I have to go and find, see, now I have to find it because for some reason, now, because I got two screens and sometimes it disappears when I do that. So apologies for that.
Analyst, of course you've got two screens. I'm surprised you don't have more today.
I
cool.
do. Just using two for this webinar. Right. So here, this graph. I was talking about trade globalization and how it's a measure of trade between countries or integration between countries importing and exporting goods, right? And the reason for putting this graph up is to show you that there's been a fairly sharp decrease in globalization in the last decade. And we need to bear it in mind when considering individual countries and regional economic growth and how maybe different countries react differently to it. By the way, it genuinely intrigues me how nationalistic the world has become. But I think that's a consequence of the growing inequality, maybe due to globalization and this fight for resources. I think that would actually make a really good research topic for someone. And then one of the more interesting or important aspects of investing, and something we're seeing playing out right now, is that it's probably not a good idea to fight central banks. The picture you're looking at is of US Fed Chairman Jerome Powell and erstwhile Governor of the Bank of England, Mark Carney. So for the record, Mark Carney, who looks like he's showing Powell the finger, is no longer Governor of the Bank of England. But because this year's Jackson Hole Symposium was done virtually, because of lockdown, I had to use this old picture. For background, Jackson Hole is a place in Wyoming where the central bankers and economic great thinkers of the world, our bankers and great thinkers included, our South African bankers, meet every year for a little soiree and to discuss economic policy. This happened about 2 weeks ago, as I said, virtually, with a very broad theme, navigating the decade ahead, implications for monetary policy. It doesn't get more boring than that. Probably the most important thing, though, to come out of that meeting was the statement by Jerome Powell, and we'll talk about it in a minute. Just for some quick background, working from the very basic understanding that some inflation is good for an economy, as you can see from the chart, US inflation plummeted during the global financial crisis, which is normal during a recession as demand for goods falls, producers are unable to raise prices because the on-sellers, the retailers, if you like, can't pass it on to their clients. So of course, inflation drops and you don't see this increase in prices. But then on the 25th of January, 2012, the then US Federal Reserve Chairman, Ben Bernanke, set a 2% target inflation rate. Now you'll know this if you're South African because we have an inflation targeting mandate for our Reserve Bank. I think it is 3 to 6% still, if I'm not mistaken. What used to be a range of 3 to 6%, and then they decided they'd make it 4.5%. Of course, inflation now at what, 3-point-something%. Hopefully we'll get another rate cut, even though I know our central bankers and they tend to be very dovish. They really don't like hiking interest rates. Cutting interest rates. They don't like cutting interest rates. Anyway, so that pretty much brought the Federal Reserve in line with other major central banks around the world. But as you can see from the chart, there's been a significant undershooting of this 2% target. So watch the red line, you'll see that actually that's below that average is below the 2% target. Enter stage left or stage right in my picture, Jerome Powell, who 2 weeks ago said that the Fed would switch from net targeting this 2% to average inflation targeting of 2%. So what this means basically is that they could allow inflation to run above 2% for a number of years still to come to make up for this previous decade of undershooting. And what that means to you and me is that we are unlikely to see tightening of monetary policy for the next couple of years. So in other words, interest rates are likely to remain lower for longer. And as you can see from the picture, that's good for the bulls. In addition, he said that the Fed's second goal of full employment would see a slight tweak to the definition of maximum employment, looking at the broader view of labor market gains. All very complicated, but basically, we've already seen the US economy bounce back. As you can see from the chart, this is the chart of unemployment. It's been steadily decreasing post the global financial crisis, then of course the spike at the onset of the lockdown. But last July, data showed that home sales were the strongest they've been since 2006. So actually, post-COVID or post-lockdown, we're already seeing quite a nice recovery in the US economy. Granted, I think I must point out that the sectors like services and tourism are still struggling quite a bit. But yeah, I think not to worry. The US Fed is not shy of supporting the market. And I think we could see some continued asset purchasing until they reach this average 2% inflation rate that Jerome Powell was talking about. Just a hop, skip, and a jump across a couple of continents. Here's something. Revenge spending. The post-coronavirus buzzword in China. It basically refers to the impulse to shop after months of being cooped up in quarantine. And I think we probably all understand this a little bit. Listen to this. One Hermes shop in the southern metropolis of Guangzhou made $2.7 million in sales when it reopened on April the 11th, the highest revenue made in a single day for a boutique in China. I mean, it just blows the mind, right? The minute lockdowns open, they all go and buy fancy handbags. But I would say don't read too much into it though. While revenge spending is a buzzword on the Chinese internet, I think the trend really is for people who can afford it, right? So put the buzzwords away, let's look at some real numbers. This is a graph of China's annual GDP growth rate, and it's definitely telling you something. Now you know why people are looking forward to a V-shaped recovery. I mean, I've actually circled what looks like a V in their GDP growth number. And really, maybe China is a good example in a way, because I think it was first in and first out of the coronavirus. And I think most activity has already returned to normal, with again, though, services and travel being a bit slower than pre-COVID levels. And I think for obvious reasons, right? I'm not going to explain that too much. And here's another very interesting infographic and another interesting buzzword: globalization and reshoring. I'm taking no credit for this one though. This is something I heard in a Morgan Stanley global conference the other day. So eyes top left of the infographic. Yep, that's got my left and my right, correct? It shows that the total overseas spending of Chinese consumers last year was $260 billion US, broken down into tuition, student living expenses, luxury, beauty, and travel, and others. So reshoring, as Morgan Stanley are calling it, now refers to this spending in China for China. And I can literally put that in inverted commas, because it's really being driven by the stay-home economy. And Morgan Stanley estimates that reshoring will lift domestic consumption in China by approximately $100 billion per year for the next 3 years. They do make the point that the sectors likely to benefit most, though, are kind of beauty, sportswear, travel, and leisure. So people are now not jumping on a plane to go to France, but rather staying home and traveling locally. And then there's this derivative of globalization, slowbalization. I feel like someone at Morgan Stanley is wanting to write a movie script or something. Taken straight from the Morgan Stanley conference that I attended, because they put it so succinctly, actually. The urbanization program is a 5-year program in China, which will support internal growth and end in the country having 5 super cities, they call it. Super cities, they measure with populations of 120 million people. That's twice the size of South Africa by 2030. So 5 of those in China. Of course, that will increase commuter rail. In fact, Morgan Stanley are predicting that commuter rail in China will increase by 8.5 times, and that they will triple the Internet of Things market to $1 trillion US. These are just staggering numbers. And of course, following on from this is what we call smart cities. China is very focused on safer living environments, reducing crime, reducing traffic accidents, lowering their pollution. So all of this really around this idea of smart cities, massive cities, with what we call tech localization, you know, with local Wi-Fi, with local online shopping, just everything kind of going online. And then and then RMB internationalization, this is an interesting one as well, because, you know, the RMB is not Rand Merchant Bank in this case, by the way, but stands for the renminbi. And the approach really here, China's approach, is 3-pronged. And it includes local spending as well as kind of cleaning up their financial system and opening their stock and bond markets to the world. And I just feel like with all this going on and what I've seen historically, I'm not sure I'm going to bet against the Chinese government's ability to implement their targets or implement what they say they're going to. Moving just very quickly to the left, European Union annual GDP growth rate. I mean, what a disaster. I actually don't even know what to say about that graph. It just looks absolutely terrible. But here's the thing. On the 18th of March of this year, the ECB, the European Central Bank, unveiled PEP. It stands for Pandemic Emergency Purchase Program, which is a temporary program to purchase up to 750 billion euros in public and private sector securities until the crisis phase of COVID-19, as they put it, is over, but at least until the end of 2020. So they're going to be purchasing bonds and equities, in other words, supporting the market, and they'll do it for as long as they need to. And I think despite the previous graph showing the dire state of the economy, the feeling is that Europe is actually performing better than economists expected. I mean, like they're kind of lagging less than we thought they would, which is quite funny, like quite a horrible thing to say about them. And quite frankly, I can only attribute it to the fact that they have a coordinated policy response. So, and what I mean by that, so a coordinated policy response. So if you think about countries that were the worst affected with the virus, Italy, right, that comes to mind immediately. They also happen to be the southern countries that have the most debt, Italy, Spain, France, maybe not so much, even though they were quite badly affected. But at least the ECB can coordinate the stimulus, and the debt burden is shared. You know, it doesn't just fall on the shoulders of Italy. Like for us, for example, when we go off to the IMF and the African Development Bank and borrow 5 billion rand it was, from the African Development Bank, we have to repay that debt. Here, it's like an ECB problem almost, like a shared burden. I mean, I don't know what Germany thinks about that, but that's not the point here. So I think Europe also, maybe I must add that Europe also seems to be more prone to a more cautious approach to managing the virus, you know, a bit like Jacinda Ardern. The minute there are more cases, then they want to lock down, and they still have quite stringent restrictions in place, even though they opened up before that. But also there's kind of an assumption between economists around the world, which I'm not sure I totally agree with, right? But the assumption is that there'll be a vaccine by the second quarter of next year, in which case I actually think Europe is going to return quite quickly to pre-COVID levels. And until then, if they don't, they'll just continue implementing this, what I'm now going to call synchronized stimulus, if you like. Just moving to their next door neighbors. While we're talking about the EU, let's talk about Brexit. So, I mean, I think, you know, the UK is in a very similar position to Europe. It has COVID and it's a problem, and they had lockdown. But I think on top of that, they now also have this deal that they have to sort out called Brexit. And on Boris Johnson, actually, I think it was last week, gave October the 15th as a deadline for this post-Brexit trade agreement with the European Union. And he basically, you know, is pointing to, well, if there's no deal, then so be it. You know, talks will fail and we'll just leave and move on. I think the Brits are fairly upset about that. They think he's being a bit bolshy, but there's no accounting for politicians. I'm not even going to get into that debate. So yeah, definitely something I want to avoid, this discussion on political brinkmanship. And actually, here's something. If I didn't label the graphs, would you be able to tell the difference between the EU and the UK? So I've just run the UK GDP growth rate over the EU growth rate. And actually, the only difference is that the last print was a contraction of 20% in the second quarter, where in the EU, they had a contraction of 15%. So negative interest rates have been speculated about because they have to do something about this. And I don't see that is going to stop them at all. It appears as if the governor of the Bank of England has already hinted, you know, to measures potentially being introduced. So it's not all bad news. Bank of England data for July showed that the number of mortgage approvals for house purchases soared to 66.3 thousand from, I think they were 30 or 40,000 in June, and slightly better than expected of 55,000. So we're definitely seeing some green shoots in the UK economy. And I think we could probably read this as positive pent-up demand on the back of kind of this lower interest rate environment, because of course mortgage repayments are now very low if interest rates are zero. And of course, the other thing that the UK did was that they cut residential stamp duty. Another sign, I think, that they're just prepared to do whatever it takes to stimulate the economy. Again, unfortunately, like I think almost every other country or region except China, the UK high street or their shopping or their retail sector, if you like to call it, just haven't been that lucky. Just yesterday, the Center for Retail Research announced that so far this year, 125,515 retail jobs have already been lost, and 13,867 shops have permanently shut. But not to worry, the Department of International Trade, DTI, as it's called there, has announced new trade measures to help support consumer and retail businesses impacted by the coronavirus pandemic. The measures will seek to boost export and increase UK retailers' readiness to sell overseas. So you see where this is all going. We're all kind of in the same boat together. We've all experienced this COVID crisis. And I think what we need to do is look forward to see where we're actually going to be. And that's pretty much kind of my overview of where we are at the moment. I must just tell you, I must take this opportunity to tell everyone that Cartesian is launching an offshore investment product. We're specifically focused on keeping costs low, finding the right partner to help with your Reserve Bank applications if you're sending Forex offshore, and then putting together portfolios that encompass good global diversification strategy. And if you need to be in touch, please email me on info@cartesian.co.za.
Right, thanks, Cynthia. So I want to kick off immediately by chatting to you about cost. So two things related to that. Firstly, how much money do you need to have to be able to go offshore? Is this still the purview of people who are super wealthy or institutions? And secondly, what are the maximums and minimums allowed?
Right. So it's not about minimums. What it is about kind of a break even. So if you're going to take money offshore, the couple of costs that are included is, of course, you have to do your forex. So you can't just go in and deposit your rands at HSBC in London. You actually need to convert. So, and we're looking at between 8 and 10 basis points, right? So 0.08%. So that's your first cost. Then there's the cost of, obviously, well, there's no cost, but it's a time cost of, if you're going to take more than R1 million offshore, you need to apply to the Reserve Bank to get approval to take this R1 million off. In fact, you can actually apply, you can do it up to 10 million. So that's probably your maximum. So your first million, you can just send off, I don't know, via your bank. Your bank normally has a forex option. You just deposit the money offshore, and anything above that to up to 10, so now we're up to 11 already, you have to apply for approval. And anything above that, we have to do what is called an asset swap for you. So we can do it for you, but invariably that money almost has to come back. So really, if you're really offshoring, leaving it on the other side, not wanting to bring it back, I would say your max is 11 million rand a year. But of course, if you want to invest more, we can certainly do that for you. From a cost perspective, it really depends on what you're buying again. So from an asset management perspective, we're creating 3 model portfolios, and we're pricing them really cheaply, 1/3% basically. But on top of that, of course, you also need to add your advisor fee, which could be anything from 0.5% to 1%.
Great, thanks.
So Carol, sorry. So when we talk about minimums, what I'm trying to say is that it has to be worth your while. But no, I absolutely think you must consider sending money offshore, no matter what amount you've got.
And then I also want to clarify, because what you're not talking about, to my mind, is a currency play. So you're not saying take your rands offshore into a foreign currency and leave it as cash. It gets back to your point about looking for growth opportunities in these portfolios.
Right. So there's kind of two things we need to focus on there. So I don't think there's any problem in taking your money offshore and leaving it in cash. You are going to earn 0 interest, though. You know that interest rates in the developed world are close to 0, and as I mentioned, in the UK, potentially going negative. But yes, I think there are growth opportunities. And I didn't really want to talk about South Africa, but I think it's going to be a long, hard road to get back to growth and to see kind of any reason for the stock market to kick up strongly. So while on the other side, you've got kind of all the stimulus coming out of the US Fed, China, even Europe, especially Europe, actually, because they know they're lagging behind. So they need to kind of kickstart the economy. And it's not just about kickstarting the economy or talking about working in a new economy. It's also this kind of almost superficial stimulus, right? Where throw money into hands of investors and they'll buy Tesla and Amazon and they just do. So you've seen kind of that rally in the offshore stock markets, particularly from that. And I think we should be taking advantage of it.
I'm going to talk to you a little bit about our retirement funding or saving for the future. So some people do that formally through a pension or a provident fund. And as I understand it, there are limitations to what those funds can invest in offshore. And so we've got a couple of questions here from people like Matthew and others. Because there's a limitation on how much money your provident fund, your retirement funds allow to invest offshore, is it better to have less money invested in South African retirement fund and follow the route that you're proposing, look at some international ETFs? Yeah, your thoughts around that?
Yeah, we get this question all the time. So I think the benefit of being in a pension fund, a retirement annuity, a provident fund, whatever you want to call it, for your retirement locally, is that it's tax efficient. If you invest offshore, that money will be taxed, right? It'll be and not as beneficially as if you were in a retirement portfolio. And that, you know, again, everybody's situation is so different. So I'm not going to say, forget about the tax, just the growth you need to get is offshore. So let's go offshore and do it. I think you need to have a nice balance I would say you definitely need an offshore portfolio, even if it is not perfectly tax efficient. And as you said, this Regulation 28, which is the regulation that regulates pension funds, puts a limit on how much your asset manager, can actually invest offshore. So yeah, you definitely need to add to your offshore allocation of your portfolio, even and especially if you have a local pension fund.
Now, I know you don't want to talk about South Africa, but I'm interested in the term that you were using or reusing, reshoring in the Chinese context. Do you think that there is going to be a forced reshoring by our government of our money and direct it far more where we're needing to put our cash? And would that indicate that we need to take advantage of some of these offshore opportunities sooner rather than later?
There's a couple of aspects. So already, we have reshoring from basically the apartheid days. And we had, what's his name, the engineer, Trevor Manuel, when he was finance minister, he tried to undo these exchange control regulations and to say to you, well, you don't have to invest. You don't have to keep all your money here. You can take some of it off, right? Do I think government is going to reintroduce stricter exchange control regulations? No. But what they have done, which kind of shocked me a little bit, was announced that if you are immigrating, that if you haven't been overseas for 3 years, you have to wait 3 years before you withdraw your pension fund money and take it offshore. Now, most people I know who are immigrating, who are leaving the country for what they think are greener pastures, probably actually need some of that retirement fund or that retirement money to go and settle offshore, because that's just how my friends apparently work. Most people, I think, would need to do that. So I think that's a bit of a shocker. That regulation comes into play on the 1st of March next year. So if you are thinking of immigrating, I would say yes. I don't think you want to be stuck in a situation where you're leaving, you're going to set up a life somewhere else, and you can't get your money out for 3 years at least. I think that just makes it so much harder. And then that's what I've seen so far. And then from an investment perspective, there's a lot of talk about prescribed assets, meaning that they want to take your pension fund and invest it into kind of infrastructure projects or longer term in private equity investments, which is not I've mentioned this before. I don't think it's a problem. Lots of countries do it. I think the problem is that we as South Africans don't trust our government to do a good job of infrastructure investments. So to answer your question, must you take money offshore? Yes, absolutely. 100% you must take money offshore. Do you have to now panic and take all your money offshore? No. Although, have you seen how strong this rand is? It blows my mind. If you're not taking, and this is the worst, Carl, I can't tell you, it's the funniest situation. When the rand blows out, when the rand goes to 19, like it did in March, April of this year.
Not long ago,
then all my clients phone me up and go, oh my goodness, this rand's blowing out. I need to take money offshore. So you're like, yes, but the rand's trading at 60 or 50 or 40, 1650, call it, right? Nobody's phoning me up and saying, oh, the rand's so strong, I really need to take money offshore now. And I think people need to wake up to that idea that they need to take money out while the rand is strong, actually.
I think it's a very good point, and particularly up to that R1 million limit, where it's easy. There's nothing.
Exactly.
So I fully agree with you. And here I'm keen to hear a little bit about Britain. I know you don't want to get into the politics, but with talk about Boris and his great hairstyle breaking some international protocol, maybe not law, how risky do you think that is if we've got investments in the UK and things that are linked to the UK?
Yeah, so I do think the UK is probably going to be the laggard economy for a while still. So although it's not, as I said right at the beginning of my presentation, there's so many things to consider, but the one thing that kind of overlays all of what I'm thinking when I'm looking at the fundamental data is that these central banks and governors will do whatever they need to do to keep this economy going. And even Boris, he knows that you know, if the economy just plummets after Brexit or after his no deal exit, or whatever he wants to call it, he'll be in trouble and he'll be looked frowned upon, you know, kind of leave a terrible legacy. So yes, I think Brexit is a disaster. I can't believe that actually even happened. But I think the policymakers will do what they need to do to keep the economy kind of afloat, if you like, at least, right? At minimum afloat, and then kind of pick up after COVID. And so Carl, here's the thing. Here's the difference between a lot of countries and the countries I've specifically named, is that they actually have the ability and the tools to do it. So the UK has no problem going into negative interest rates. Actually, the only economy that didn't use stimulus during the COVID crisis was China. But they've got all these great plans in place anyway. So kind of you want to get on that bandwagon. But all the other, like the US, Europe, UK, even Japan, which we didn't talk about, but kind of it's been a lost decade, and I guess for them it's going to be a bit more difficult to come out of it. There's just no inflation at all. I think these big developed economies have the tools to stimulate their economies out of a recession, which we don't have, unfortunately.
Yeah, thank you. Just a reminder from me to everybody listening that you get your hour CPD for this, and your certificate will be mailed to you, so you don't have to do anything. But just before I forget to tell all of us that we're earning an hour. So thanks, Anthea. Let's delve a little bit deeper into these specific markets. So you spoke a bit about China. You've mentioned a few others. What about places like Australia? Are your funds looking at markets like that, or are they just too boring, lack of opportunities? And linked to that, you know, we've reminded people, or I've said to people in the past, you don't sort of wake up, thumb suck, pick a stock. There's research. So, I mean, there must be a wealth of information for these overseas companies as well that you guys are working with.
Sure. So when it comes to Asia, or kind of that side of the world, I must admit, I tend to lump them together. And I prefer, again, the developed economies over the kind of emerging economies, for the reason I mentioned, that I prefer, you know, if I'm going to take my money offshore, I've already got so much local exposure, which is an emerging market, that I want to diversify properly. Australia, an interesting market. Oh, no, that's not true. Actually, it's dollars dead shorter. It's not that interesting. So no, I haven't spent that much time looking at it, and I don't feel like, oh, I need to consider to put 5% or 10% of my portfolio into it. You know, maybe kind of I'll have some exposure via an Asian sector exposure, or regional exposure, I should say, not sector, regional.
Interesting. So tell us a little bit more about the three. I mean, what are the differences between them, and what are you guys looking at?
Between the
three funds that you guys are looking at.
Right. So the three funds, basically, it is just a matter of risk relative funds, right? So the regions that we like will be kind of more or less the same, but the assets we invest in will either be equities or fixed income, or kind of a combination of those. And we all know that equities or shares or stocks, whatever you want to call them, are more risky, more volatile than a bond portfolio. Now, unfortunately, the less risky portfolio, if you are going to be invested in global developed markets, is going to return very little, but it will be a much lower volatility. It'll have a higher exposure to the bond market, but as the bond market in developed markets at the moment is paying nothing, your returns will be fairly low. Whereas hopefully the equity portfolio, which is on the other side of, or higher exposure equity portfolio, will return give you a higher yield or higher return over the time that you're invested, but it'll be volatile, you know, so it's not a portfolio to look at every day. And the point of doing that is because we have crumbs, like literally, I mean, I think my youngest investor is under 2 years old. And then we've got like, and so that investor has time, you know, that child's parents have invested for decades, 20, 30 years for this child to make some money. And so they can sit through the volatility, but somebody who's close to retirement and maybe going to retire offshore, they really can't take the risk of having a volatile portfolio, because if they need to withdraw their money, or if they need to buy an annuity for their retirement, then kind of they need to know that their portfolio hasn't fallen or decreased just because of volatility, not because it's a bad portfolio, but just because volatility, and they don't have time to wait for this portfolio to kind of spike up again. So really it'll be more risk adjusted than sector or region distinguished.
Yeah, and I think one of the quotes I like about risk that we've spoken about before is it's often riskier not to take risk, and so you need to evaluate that as well where you are in your life. I saw yesterday that is it Louis Vuitton, what are they called, LVMH, withdrew their offer for Tiffany, which was something in the billions. And so, do you think that there's going to be less interest in these really high-end brands? Or are they ones that are on your radar as well for investing? Or, yeah, interested in that sector and your thoughts around it.
Sure. So I probably brought that to your attention because of the Hermes example. So I think it was that they decided it wasn't really a good fit. I would say that that is a market that has already come under quite a bit of pressure. But historically, it's certainly on my radar because historically, wealthy people, even through recessions and crises, remain wealthy. In fact, I read something the other day that said the 25 richest people in the world have got richer during the COVID crisis, while millions have got poorer. And that kind of is how it happened. And so I think the luxury brands will be held up by the wealthy few who actually don't really feel recessions. Would I be buying a luxury brand at this stage? I'm actually not convinced about it. It's not a kind of generic, oh yeah, sure. I mean, the sectors I like obviously are the tech sectors. You know, that's just a no-brainer. You just want to have tech exposure because, I mean, COVID-19 has done for tech companies what their marketing team couldn't do for the last decade. So like it's done that in the last 6 months. So, you know, so luxury brands are not an, you know, they're not an absolute dripping roast kind of, if you like.
Interesting. Anthea, we spoke a little bit about rate cuts and you mentioned it. So instead of my favorite question to you always on a stock pick, which we'll get to, if you had to put your head on a block, are we going to see another rate cut? And if so, when and for how much?
Well, we absolutely have to. I mean, inflation really, well, I'm hoping that some of the Reserve Bank governors are listening.
Yeah.
Or to the Reserve Bank governors at least, right? I don't even need to go to God. Because inflation really has been anchored to the downside in South Africa now. But I know those Reserve Bank governors, I actually really know them well. And they are so scared of cutting interest rates. And I get that they kind of going, well, it's a COVID crisis and interest rates are low, but we've had all these cuts. We have to give it time to work into the system. That will be one argument. The other argument against a rate cut from the Reserve Bank, and I can almost hear them in my head, is that if the US Federal Reserve are going to let their inflation carry on up, it invariably is going to have an impact on our inflation. Now, I'm not sure that is completely true because I think the inflationary pressures that we're going to see in the US are not necessarily going to be demand driven. I think it'll be, you know, very superficial. It'll be kind of through the stimulus. It won't be proper kind of hard inflation, if you like. On our side, I think inflation is going to stay low in South Africa because there is no pent-up demand. So consumers, unemployment is high. Consumers are sitting there going, oh, I feel like I need to spoil myself, but I actually am not sure that I should be spending this money because, you know, my husband may lose his job or whatever the case may be. And so I think inflation, other than potentially exogenous factors like the oil price in South Africa, I think we're going to see low inflation. Should we get an interest rate cut is the question. Yes. Will we get an interest rate cut? I don't know.
Cool. Last couple of questions. I want to pick up on Steve's question, which is around tax. And he is asking the funds and the stimulus that governments are now providing to help economic recovery because of COVID. Do you think it's going to find its way into future tax regimes and how governments will be spending in future? Now, you know, my cynical answer would be, I'm not sure that people like Donald Trump even think that far ahead. But it's an interesting question to see how this will impact us from a tax perspective going forward?
Globally, okay, but so, I mean, every tax regime is different, right? But when you mention Donald Trump, I don't think he's, you know, he really is a populist ruler. And so he will implement populist measures. And so when it comes to tax cuts, I think he'll jump at the opportunity because he wants to get voted in again on the, when is it, 3rd of November, whatever. So yeah, it's very different. I kind of think across the globe, and just from South African perspective, you know, we've seen tax revenues fall because we couldn't buy alcohol and cigarettes, and poor Kisvet is scratching his head. And then we've seen debt increase. We need to service that debt. So it almost, where else are we going to get money from, basically? Where's Treasury going to get this money from to service the debt? Because now tax revenues have fallen. So it feels like they should increase taxes, even though effectively what they should do is cut taxes so that the consumer can spend, so that the economy can start going again. And so that's my kind of base case scenario. But will they do it? Probably not. I can't see that happening. Globally, very different for very different countries. The US, yeah, I think they'll cut taxes in a heartbeat. Europe, they're not big fans of cutting taxes. And I can't say Europe, each country is different. I mean, France is a nightmare when it comes to taxes. And they just don't care, actually. They're just like, well, the ECB will put money in your pocket, so pay your taxes. So it's very different for different regions and countries.
So the naysayers, Anthea, say that, you know, we should be, it's unpatriotic to take money offshore. I mean, it's balanced with some of the views you've had. One of our listeners is saying, you know, our market is so small. Why would you invest the majority of your assets in a market that's, you know, 2% or whatever of global markets? But there are those who say, you know, maybe it's unpatriotic, and also it's not necessary because you can invest in local companies that have so much of their income generated offshore. What would you say to that?
I'm going to answer that backwards. So the companies that have so much of their income generated offshore in the last 10 years have lost 300 billion rand.
That's
right.
a good answer.
Shall I name them? Sasol, famous brands. I mean, there isn't a South African company that I can think of that hasn't written down some Woolworths, some form of offshore investment, right? So let's like kind of go with that. Then emotional, pragmatic, patriotic. Yeah, like those are not words that sit comfortably with me. Like I'm not, when it comes to investing, I'm not nearly emotional enough. I'm not even patriotic. Like I don't have this, I'm South African and I have to invest here and I have to live here. I'm here because I want to be here, and I'm investing here because I think there are good opportunities, and I'm investing offshore because there are good opportunities and I need diversification in my portfolio. And I guess, you know, that's to each their own decision, I think. The irony of what we're talking about at the moment, actually, is that there are so many cheap South African companies. They are, when I think about how these banks have just been absolutely pummeled, they're dirt cheap. And sure, I do think, you know, it's a good opportunity to get in. And then there are so many expensive companies offshore. It's mind-blowing. But again, I'm back to my economic basics, right? So it's all good and well saying that the banks here are cheap, but we're yet to see those non-performing loans come through. We're still yet to see consumers not repaying their debt, that sort of thing. We don't know how this is going to play out. And what is the catalyst to push those shares higher if they are so cheap? Flip side, on offshore, those shares are just ridiculously expensive. I mean, some of them trading at PEs of over 100, but they're backed by catalysts. They're backed by central bankers who are just dropping cash onto consumers and investors and going, thanks, off you go, and I'll go and make something of it. So a difficult one, I guess. There's no absolute answer, I think, on that one.
I do think, though, that your point is very valid, that emotion, it's not just you. Emotion really shouldn't play much of a role, or any role, when it comes to investing. I mean, people need to be clear about what their outcome is required and have a strategy and stick to it. If we're going to be emotional or patriotic when it comes to investing, I think you really end up burning your fingers. So, Anthea, now, stock picks. What are you suggesting for us in this?
Okay, this is easy, right? This is global. I mean, I've already mentioned all those stock picks. I'm not going to mention Tesla because I can't.
Say, please, not Tesla.
Can't get my head around why that company's trading the way it is. But But there's a very cool company, a global food company called Cisco, not the old computer Cisco, you know that CISCO? This is Cisco, SYSCO, and I think the stock code is SYY. So have a look at that, that's worth a punt. Airline stocks really have been hammered, but some of them have bounced back, kind of forward pricing. But there's a company called Amadeus, which aggregates, sorry?
Do they do the ticketing?
That's the bookings and the, you know, the kind of background admin stuff of it. That's a company worth looking at, Amadeus, and it's listed. And then because I'm like such a China bull at the moment, I think Alibaba probably you need a bit of a punt in as well. I'm South African, right? So I can't say Unilever because they make Tresemme, but I can say Johnson & Johnson. So maybe let's go with Johnson & Johnson for now. And these are all kind of on the back of economies coming out of the COVID crisis and buying and shopping and kind of things going back to normal. These are companies that were good companies, solid companies that were decimated or kind of under pressure just generically because everybody else was under pressure. So good companies, I think.
Yeah, and I think, you know, as a relatively run-of-the-mill retail investor, I've loved the opportunity this week with the dip in China and a few other places to really get into the market, you know, and I couldn't agree with you more that now's the time with the strength of our rand as well. So Anthea, in concluding, we've got a mixed match of people here. We've got very experienced investors, we've got some existing clients, new clients, and I think most people know that I'm very critical of you doing a very poor job about marketing yourself. So I need to do so unashamedly. But, you know, how do people get involved with you? So yes, we can email you, but do I need to have a financial advisor? I mean, if I want you to look at holistically what I'm doing, yeah, just very briefly, how does that happen, please?
Right, so just email me. We have everything you need. If
Short answer.
So if you know what you want and you just want to start a portfolio, an offshore portfolio, I will send you the mandate, you sign it, I'll tell you where to invest your money, and off we go. If you need financial advice, definitely come to me. I don't do the financial advice myself, but I've got a host of handpicked, very good, very clever, very considerate, because that's what you want. You know, you don't want an advisor who's just going to charge like a wounded buffalo. You want a considered financial advisor. I've got a handful of them that I will point you to, depending on what your needs are. What I don't do is insurance, though. So maybe.
Right. You'll make enough money. We'll self-insure.
Okay.
And where's your next overseas destination? One day when you can travel again, as somebody who's traveled a lot, lived all over the place. What's next up when you can fly?
Yeah, I don't really have a choice in this, actually. So I have a holiday home in the south of France, which has been not looked after during the COVID crisis, which I need to go and update, put it that way. Not major renovations, just a few new curtains and that sort of thing. So I'm off to the south of France as soon as.
Good. Well, fingers crossed that happens before too long. So thanks very much, Anthea. It's been really fascinating listening to you. And it's always good to hear your considered views and really appreciate it. Any hints on what our next webinar is going to be, or do we need to watch out on our email and social media?
Oh, I haven't thought about it. You and I can put our heads together. How's that?
Cool.
There's so much, right?
There's so much,
Okay.
and there are great opportunities at the moment. So look forward to your future views, and thanks everybody for joining us. We'll mail you your CPD certificate and also a link to Anthea's chat. And have a good, happy, successful investing rest of the day. Cheers, everybody.